So this is Cava. We spoke about Cava so much about a year ago. I think it was a year to the day, Steve, that I sold it. Time has flown there. They've dropped some pretty tasty looking numbers, and this was a stock that I liked a lot around the 55 to 60 kind of range. And a couple of months later, I didn't like it very much around the $100 range. Since then, I sold it. The stock flew up about another 50% to the sort of 150 kind of range, and then crashed all the way back down to the 90s. So I feel a little bit sort of liberated. Which, speaking of liberated, on that day it fell to 80. Still not confident that was a great price, but I'll explain why when we go on. Sales were up about 28.2% year on year. That's 328.5 million. That actually beat expectations just by a fraction. Same store sales, Steve, up 10.8%. Very good. Very good numbers, that is. Customer traffic was up 7.5%, and in the quarter they opened about 15 new restaurants. What I think you'll really like, though, is the scale and efficiency is now starting to show. Operating income was up 68%, net income up 84%, EPS up 83%. Yeah, that's impressive. We're starting to see some of that sort of operating leverage that they get as they get to bigger and bigger scale. In the most recent roundup of 13Fs, Cava has actually appeared in about half of the top hedge fund portfolios now. So yeah, that was really positive. Stock went down a bit though, and I think it was the guide that let them down. They said that same store sales would be up about 7% year over year, and the analysts was expecting a little bit more. They were hoping for 8%. The restaurant margin guide, they just reiterated what they gave on the previous report, and analysts wanted it to improve. They raised their EBITDA guidance by about 1.3%, but analysts expected stronger growth. Given the results we've just had, Steve, maybe that was a little bit sandbaggy. They're giving you low expectations and then just want to beat them. But I guess we'll see that in the coming quarters. Balance sheet, still great. This always had a decent balance sheet, 370 million in cash, no debt. Still looks really, really good. So about 11 billion in market cap now. The P is around the 80 mark, well over $1 billion in trailing 12-month revenue. Still committed to the 1,000 restaurant mark by 2032, Steve, that we used to speak about. It's at about 382 at the moment, so it's a treble from where we are today. In the call, there was some interesting stuff, Steve. They're launching a steak and harissa bowl. Remember when we used to do this? When we were covering Cava, we spent the first minute talking about some of the food we'd like to try. And there's a spicy lamb and avocado bowl to go with that, Steve. But those folks will never own a house. Also, they discussed how they're leveraging AI technology. And they said they have a system that looks at the chefs and prep workers and what they're doing and assists them on things like presentation and cooking times, etc. That sounds to me like being micromanaged by a man behind a camera, but they called it AI. One of the huge bright sparks that was discussed in their call was this loyalty program that they launched a year and a bit ago. That's now 8 million members with 50,000 new registrations coming every month. So Cava is very much still the hot product out there in the sort of restaurant space. So I use my reverse DCF again, Steve, and I work out that they're going to need to grow free cash flow by about 40% a year for the next 10 years to justify today's price. And that sounds like a lot, but the end figure you're going to get to is about 1.5 billion in free cash. So if store opening trajectory continues, I'd estimate it would be about the sort of 1,200 to 1,250 mark by the 10-year period. But even so, let's model it using Chipotle's numbers. You're not going to get to 1.5 billion in free cash flow until about the 8 billion mark in revenue and until you've got about 8,000 stores. Cava's quite unlikely to hit that so fast, if at all. I think even at today's prices, which is essentially where I originally sold it, I think we've got a similar problem to the reasons why I sold it. I think the math don't math, Steve. But I like the business a lot. I'm just going to leave it on the watch list though.
Interesting. I had a slightly different way of looking at the numbers here to you, and I thought the maths almost exactly maths, which means that I don't see this as particularly undervalued, but I see it as pretty close with some workable assumptions here. So at the moment, average restaurant profitability is 215,445 dollars in the first quarter for what they're looking at. So times it by 4 and then times it by 1,000 when you apparently operate at scale for the moment, and that's where we would be once we finish building out all these restaurants in however long it is. Fair enough. And then from there, it becomes a question of, well, exactly how much are we going to kind of grow this thing by, which I thought they're currently looking at same store sales of around 10.8, just short of 11, you were saying, and they've been okay. They've been kind of around and about in that level in over the last few quarters. I was looking back, they were 10.8 this one, 21.2 in the last one, 18.1 before that, 14.4 the previous quarter. So it's, I don't know, it was a trend up and then it's a decent step down and a step down kind of again on this one. But I think there's sort of reasonable same-store sales growth here. I'm delighted, of course, that this is a number that you look for in the guide and think, yep, that's what we should be paying attention to, because basically all I read when it comes to these kind of things. That times number of stores. I thought from there, if they can maintain that kind of profitability level, it doesn't get to being sort of too crazy here. If you work backwards from sales, try a 15% operating margin for what Chipotle currently manage. Could they manage slightly better? Could they manage slightly worse? Yeah, maybe, but that's probably roughly where I see them landing here in a similar way. I thought this looked like you were getting to sort of around 25 times earnings once this thing's at scale, which is probably a bit high for a restaurant thing that's not going to be opening huge numbers of more outlets, but assuming they'll grow a bit between now and then, sort of knock off 10% each year for now to 2030 or so. I got to it slightly high. I got to it not being crazy high, though I can sort of see why it's landed around here for the time being. So I thought this was probably about right, which doesn't particularly fill me with enthusiasm to go and rush out and buy it, to be honest.
No, it's strange that we're getting totally different numbers on here, though. I think I for me, I can't get there. I just think it's a little bit too far out. I think the biggest issue we've got is that they're only just flipping to profitability. So obviously we're seeing those impressive headline numbers is what they are, but we're not. We just don't know what happens from this point forwards. Obviously, they're not going to go at 80% forever. That would be incredible. Yeah, I think free cash flow has to have a lot of growth ahead of it, and obviously I'm not factoring in any dilution or anything like that, which could come along, and that hurts my model more and more the more I kind of plug in the extra numbers. So yeah, maybe one for the people at home to tell us who's right and who's wrong, and whether you're interested in Cava or whether you just want to talk to us about the steak and harissa bowl or the spicy lamb and avocado bowl, Steve. I think I would be on the lamb.
I think I would be on the steak and harissa because I would basically swerve the avocado in this situation. I think avocado, though, is probably a pretty high margin product for these kind of organizations. I tend to have, by the way, a terrible eye for what's going to do well with these things, because three restaurants so far that have done varyingly. One of which I was definitely wrong about, which was Sweet Green, and I thought that can't work. There's something wrong with the world if that works. The US needs a recession if Sweet Green works, and it appears to have worked quite well. And I still think the US needs a recession. Cava, which I didn't really have much of a view on, and I'm very much agnostic about. So a lot of what I'm thinking here is based on them achieving the things they say they're going to achieve, and it's not a straightforward path to that necessarily in this industry. And the third one is Tortilla, which is a UK basically version of Chipotle Mexican Grill. I think it's great, but the one in Oxford has just closed, which tells me that the company's not doing as well as probably I thought it was. It's a sort of small AIM-ish type thing, or small cap type thing from the UK. Not sure why it's not doing better, because Mexican stuff, I'm not just because Chipotle Mexican Grill, I think that can really work and it makes a lot of sense to me. What does not make sense to me is expensive salads, but that is doing very well in the States. So, yeah, I'm not a good one on this from a qualitative side. If I look at their numbers and they say what they're going to do and I try and attach some growth to them, maybe. But I'm very much... sort of reluctant on this being a business. I'm not sure what I think about the end product. Would love to give it a try though.
Not looked at Sweet Green in a while, have you?
No, I don't need to. You tell me nearly every week about how much it's up.
It's not. It's
Is it
down
not?
nearly 53%
Oh,
year
that's
to
more
date. I
like it.
think off the top of my head.
I think that's probably
Yeah, it's
still
gone
actually not
from.
much more like it, but that's more like what I was thinking.
It's had a massive collapse because its growth rate has gone from sort of in the 20% to about 5%. And I remember the last article I ever saw about it was the New York Times with the CEO trying to describe why its salads are so expensive. And I just thought, if Steve stumbles across this article, it's gonna get sent to me. I thought I'd let you stumble across it, but no, I will find it and I will get it across to you. It's very funny him trying to basically explain why it's a quid a lettuce leaf unsuccessfully. But
I feel
yeah,
about
very
this the
good.
way you feel about Starbucks, basically, and the food in those places. Realistically, all these people need to get to the opposite of Sweet Greens, which is Greg's. And we will probably talk about this next week because they report earnings on Tuesday. I will no doubt talk about same store sales from them. I can't see. I mean, here's a bold prediction for you. We don't normally do these, but I boldly predict that Greg's is like for like sales growth is going to be higher than it was in the previous quarter. I'll tell you why next week, and the stock is going to go up as a result. So you heard it here first. Definitely not investment advice. It's never investment advice on this show, especially not when I make bold predictions like this. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.